Decoding trading volume, a crypto market essential. Trading volume represents the total quantity of a specific cryptocurrency traded during a given period. Think of it as measuring the total activity or turnover for that digital asset. For example, if 10,000 Bitcoin were traded on a particular exchange in 24 hours, the daily volume for Bitcoin on that exchange would be 10,000 BTC. This figure is a direct indicator of market interest and engagement with that specific coin or token. Volume acts as a crucial data point for verifying the strength or weakness behind any price change. A significant price increase accompanied by high trading volume suggests strong buying interest. Conversely, if a price moves upwards on very low volume, it might indicate a lack of broad support. Trading volume also reveals the level of market participation and overall interest in a cryptocurrency. Monitoring these flows of activity is essential for understanding the evolving dynamics and perceived value of different digital assets. Volume is a vital tool for confirming trends and identifying potential market turning points. In an established uptrend, ideally, price increases should be supported by robust or increasing trading volume. Volumes echo how trading activity shapes crypto prices. The interplay between trading volume and cryptocurrency prices reflects fundamental economic principles, specifically supply and demand. If a large volume of buy orders enters the market, it signals strong demand. This increased activity absorbs the available sell orders, compelling subsequent buyers to offer higher prices. High buying volume is frequently a catalyst for significant price spikes in the crypto markets. Conversely, high selling volume can exert considerable downward pressure on cryptocurrency prices. An important aspect of volume analysis is its potential to act as a leading indicator for price movements. Sometimes a significant increase in trading volume can be observed before a substantial price change becomes apparent. Traders keenly watch for these subtle volume cues to gain an edge in predicting potential market shifts. The lifeblood of markets: volume and crypto liquidity. Market liquidity refers to the ease with which an asset can be bought or sold quickly, without causing a significant movement in its price. High trading volume is intrinsically linked to, and a primary driver of, market liquidity. When a cryptocurrency experiences a high volume of trades, it signifies a robust and active marketplace for that asset. This activity translates into a deeper order book, making it easier for an incoming trade to find a matching counterparty. A consistent and high trading volume is a strong indicator that a cryptocurrency possesses good liquidity. High liquidity minimizes the risk of slippage, which occurs when a trade is executed at a different price than anticipated. In contrast, markets with low trading volume suffer from poor liquidity, presenting several challenges for participants. Section 4. Reading the tea leaves. Volume signals for all traders. Retail traders frequently rely on trading volume to validate their technical analysis and trading decisions. A breakout accompanied by a surge in trading volume is considered more reliable. Institutional traders scrutinize trading volume to gauge market depth and the feasibility of executing substantial orders. Specific patterns in trading volume can offer valuable clues about potential future price action. A sudden and sharp spike in volume during a period of otherwise low activity can be particularly noteworthy. Recognizing these nuanced volume patterns is a skill honed through observation and experience. It is crucial to remember that trading volume should always be interpreted in conjunction with other forms of analysis. Section 5. When volume roars, real-world crypto market tremors. One of the most prominent real-world examples of volume's impact was the Bitcoin bull run in late 2020 and early 2021. As Bitcoin's price began its ascent, breaking previous all-time highs, trading volume across major exchanges surged dramatically. This massive increase in volume signified widespread global interest, drawing in a new wave of retail investors alongside increasing participation from institutional players. The meme coin phenomenon of 2021, featuring cryptocurrencies like Dogecoin and Shiba Inu, offers another striking illustration of volume's power. These assets often experienced incredibly rapid and parabolic price pumps, accompanied by extraordinary spikes in their trading volume. Market crashes and significant corrections also vividly demonstrate the role of trading volume. During the widespread crypto market crash in May 2021, panic selling gripped the markets, characterized by extremely high trading volumes. Major project-specific events, such as network upgrades or the launch of new features, can also trigger significant volume changes. Section 6. The unmissable metric: why volume vigilance pays in crypto. Understanding trading volume is crucial in the dynamic and often unpredictable realm of cryptocurrency markets. Volume provides an invaluable lens through which to view market sentiment and the level of participation. By diligently observing volume, traders and investors can gain deeper insights that price charts alone often fail to convey. Trading volume plays an indispensable role in confirming the validity of price trends and in assessing the overall liquidity of a market. The utility of monitoring trading volume extends to both short-term traders and long-term investors. In conclusion, trading volume stands as an unmissable metric for anyone involved in the cryptocurrency space. Mastering the interpretation of trading volume empowers individuals to navigate the exciting, yet often challenging currents of the crypto landscape with greater insight and confidence.